Recently, I met with someone who's looking for a second opinion on their investment portfolio. He considered himself a savvy investor and was proud of what he'd built and how well diversified he was. There was a huge problem though, that he couldn't see, but I could. And it may be something that hinders your portfolio too. You see, he fell into a trap that many retail investors do. His portfolio was full of redundancies, overlap, and hidden fees that were robbing his performance and literally costing him thousands and thousands of dollars every year. While everyone is telling you that a good investor diversifies, what they don't tell you, that I will, is how you diversify is just as important as picking the right investments. Because if you don't know how to diversify correctly, it could mean the difference between staying retired or having to go back to work. Or worse, moving in with your kids. Do you want that? Then let me show you what can go wrong with diversification and how to do it the right way. Before I do, if you want to learn how to maximize your money, we teach you that right here, so subscribe. So let me get back to the story and tell you about the man who came to see me. I'll call him Mr. Diversified. In my community of Carlsbad, California, I teach classes on retirement planning. And as part of the class, I offer students the opportunity to get a portfolio audit at no cost. This is where I review their investments and show them what they're doing well, and I show them areas that can be improved. And after looking at Mr. Diversified's holdings, his portfolio audit showed that he owned 32 mutual funds, 21 ETFs, one money market fund, and over 93,000 stocks. He was diversified, right? Wrong! This was horrible. Take a look at this report, which shows the summary of his holdings. Folks, there's only 3,600 stocks on the New York Stock Exchange and only 53,000 stocks worldwide. But he owned 93,000 stocks. Think about that for a second. The numbers don't add up. How could he own almost twice as many stocks that are traded in the world? It's because Mr. Diversified owned the same stocks over and over. He owned them multiple times. Take a look at this. He owned Microsoft 10 times. 10 different mutual funds in his well-diversified portfolio owned Microsoft. Do you think that when Vanguard went to sell shares of Microsoft and T. Rowe Price went to buy shares of Microsoft on the same day, you think they called each other to talk about it? Of course not. Those guys hate each other. It'd be like the Dodgers calling to discuss their playoff strategy with the Padres. Not gonna happen. While we're on the subject of Vanguard and T. Rowe Price, let's talk about those guys on Wall Street. Mr. Diversified's portfolio wasn't just being hindered by redundancy. He was also tipping his mutual fund managers. How? Take a look at this shocking statistic. While his average expense ratio was 0.3%, there were hidden fees that were nearly 3 times that amount that were robbing him dry. It's called the turnover ratio, and if you don't know yours, you need to, because it matters. The turnover ratio is the amount of times that stocks in a portfolio are sold or turned over. His turnover ratio was 87%. Since Mr. Diversified owned 93,000 stocks, there were over 83,000 trades placed in his portfolio last year. And do you think those trades were placed for free? Of course not. Wall Street doesn't do anything for free. A turnover ratio of 87% would be an extra 0.87% in hidden fees. Couple that 0.87 with the publicly disclosed expense ratio of 0.3, and his total portfolio expense was a whopping 1.17%. So if investment returns were 7%, what he really would have achieved was only 5.83% returns, and the rest of the profits lined the pockets of the New York brokers. He tipped them, and he didn't even know it, and you may be doing it too. For less than that 1.17%, he could have worked with Seaside. He could have gotten access to a full team of certified financial planners, institutional grade money management, tax reduction strategies to keep more money in his pocket, all at a low internal expense ratio. While it's bad enough to tip your do-nothing mutual fund managers, what's worse is when you tip Uncle Sam. And Mr. Diversified was doing that too. You know that 1099 that you get each year in February that lists gains that you need to report on your tax return? And you think to yourself, I never saw any extra money in my bank account. I didn't make any trades. I didn't sell anything. Well, all those unwanted trades from mutual fund managers on the East Coast lead to a higher tax bill because it's considered income. Income that you have to pay tax on. Imagine you go to sign your tax return and right above it is a line about how much of a tip do you want to leave. In today's tipping culture, this is normal, even for self-service. But when you have an over-diversified portfolio full of fees, you're literally giving your money away in the form of taxes. Your dumb diversification is funding the next raise that Congress is going to give themselves. If you want to send money to your congressperson, you can do that. But at least it'll be your choice and it'll be tax deductible if it's a campaign contribution. Stop tipping Uncle Sam. I hope through Mr. Diversified's example, you can see how destructive DIY diversification can actually be. Over time, it can sink your returns. And if there's a large drawdown in the market and you don't know about its danger, it'll be too late. You'll be back to work, stocking shelves, or worse, splitting a room with your grandkids. If you too would like to have a portfolio audit, click the link below and one of the advisors on my team would be happy to take a look and give you feedback. We'll let you know if you're doing it right or if you're over diversified and losing performance due to hidden fees and tax drag. And the best thing of all, there's no cost for this. It's free. We hope you take advantage of it. Make sure to like and subscribe to the channel and share with anyone you think can benefit. Word of mouth is really helping the channel grow.